Welcome to The Explainer. All right, today we're moving way beyond just making a simple list of risks. We're diving deep into the quantitative techniques that project managers use to stop projects from failing in silence. This is really about how you trade in guesswork for something that's kind of like a data-driven crystal ball.
I want you to get a picture in your head. It's a project that, on the surface, looks absolutely perfect. Every single status report is glowing green. Every milestone is hit right on time. We call this the watermelon project, because when you finally slice into it, right before the big launch, you discover the core is a chaotic, deep, bloody red mess.
So that brings us to the big question we're tackling today, right? Why does this happen? How can you have a smart team, a detailed risk register, and still have your project suddenly implode? Well, the answer isn't about listing more risks. It's about learning how to measure them.
Okay, before we jump into the really cool tools, I've got a super important warning for you. All of these techniques run on one simple, brutal principle: garbage in, garbage out. They're really built for big, complex strategic projects, and they're completely useless without a rock-solid foundation. You need high-quality data, firm baselines for your scope, schedule, and cost, and a crystal-clear risk plan. Without that stuff, you're not doing analysis. You're just doing fancy guesswork.
So let's tackle that watermelon problem head on. Our first set of tools is all about structuring our thinking so we don't get blindsided in the first place.
First up is something called the Risk Breakdown Structure, or RBS. And look, don't think of this as just another boring list. It's more like a map that actually shows you where your risks are coming from. It's this hierarchical framework that organizes risks by their source. Is it a technical risk, an operational one, something external? And here's where it gets interesting, because this slide really frames the trade-offs. The RBS gives you this amazing, comprehensive view. It helps you see if, for instance, all your risks are piling up in just one area. But it takes serious work up front. I heard about a library construction project that tracked all its construction risks perfectly, but it totally missed the IT risks for its new software portal, just because that category wasn't on their map to begin with.
So, once you've mapped your risks, you've got to dig deeper. And that's where root cause analysis, or RCA, comes into play. This is all about getting past the symptoms on the surface and finding the underlying disease that's really hurting your project. You've probably heard of the 5 whys method, right? That's what this is all about. You just keep asking why until you hit that one fundamental issue.
The benefit here is huge, right? You fix the actual problem so it doesn't keep happening. But the downside? Man, it can be incredibly time-consuming. Think about it like this. A piece of software keeps failing its test. The easy fix, the symptom-level fix, is to just patch the code. But a real RCA might trace that failure all the way back to some super vague requirement somebody wrote 2 months ago. Fixing that is way more powerful.
Okay, so we've got our risks mapped out. Now we got to organize the chaos. And this next part, it's all about putting some real numbers and, dollar signs on these risks.
And that brings us to a really, really critical idea: expected monetary value, or EMV for short. This is basically how you slap a price tag on uncertainty itself. It calculates the average financial outcome if a risk actually happens, which lets us compare totally different threats on an apples-to-apples basis.
So how does it work? It's pretty straightforward, actually. You just multiply the probability, the percent chance of it happening, by the financial hit you take, the impact. So let's say there's a 30% chance of a server failure that would cost you $10,000. Your EMV is $3,000. Now, if an insurance policy to prevent that costs you $2,000, the math is telling you to take it. It's a powerful way to make objective, data-backed decisions.
Now let's see how that powers an even bigger tool. If EMV is the fuel, then what we're about to talk about, decision tree analysis, well, that's the engine. It's this fantastic visual diagram that maps out your strategic choices and all the potential risky outcomes for each one.
And this is where it gets really powerful. A good decision tree pulls all the emotion out of a high-stakes debate. Take that classic dilemma. Should we build a brand new factory or just upgrade the old one? By mapping out each path, calculating the EMV for different scenarios, you can walk into that boardroom and say, look, here's the data. Path A has the highest expected value. End of debate.
All right, let's shift gears a bit. We've been talking about evaluating choices we can make right now. But what about forecasting the future? This next bit is all about using models and simulations to see the whole range of what could happen.
Let's start with the one thing that's always uncertain: Time. You know, if you've been around projects long enough, you know that a single guess like, oh, that'll take 5 days, is almost always wrong. The PERT formula fixes this by creating a weighted average. It takes your optimistic guess, your pessimistic guess, and your most likely guess. But, and this is the key, it gives 4 times the weight to the most likely one. It grounds your estimate in reality while still respecting the extremes.
Now, if PERT is like a precision tool for one task, Monte Carlo simulation is, well, it's the whole power toolkit for the entire project. This thing is a beast. It literally runs thousands, sometimes tens of thousands of simulations of your project, and each time it uses slightly different random numbers for how long tasks will take or how much they'll cost, all based on the probabilities you gave it.
What you get out of it is this incredible probability distribution, usually shown as an S-curve. It doesn't give you one answer, it gives you the range of possible answers and how likely each one is. This is how you get to answer the real questions from your stakeholders, like, so, what's our actual chance of hitting that June deadline? This is how you move from just hoping to actually knowing.
Okay, so now you've got all this data, which can feel a little overwhelming, right? So where do you even start? Where do you focus your energy? That's the job of sensitivity analysis. It tells you which specific risks have the biggest potential to blow up your project. The results often look like this tornado diagram. You can see in a split second that permit delays are a massive deal, while staff vacation barely even moves the needle. Now you know exactly where to put your attention.
All right, so we've got this amazing toolkit now. But here's the catch. You don't use a hammer for every job. How we use these tools completely depends on the kind of project we're in. This is not a one-size-fits-all game.
So in your classic waterfall project, you do all this heavy-duty analysis right at the beginning to protect your fixed plan. You run Monte Carlo to figure out your contingency reserves before you've even written a line of code. But in the agile world, things are different. You expect things to change. So instead of one big analysis up front, you might use a risk-adjusted backlog, where a task to reduce a risk gets prioritized just like a new feature. You adapt as you go.
So let's bring this all the way back around. Remember that watermelon project we talked about at the beginning? The one that's all green and happy on the outside, but a total disaster on the inside? That crisis that just seems to erupt out of nowhere.
The reason that watermelon project happens? It's simple, really. It's a failure to prioritize risks with numbers. The team hears a little whisper about a low probability risk, but they ignore it because they can't see its massive potential impact. They have a long list of risks, but no real sense of their scale. And that little whisper gets louder and louder and louder until it's a roar. And by then, it's just too late.
So what's the bottom line here? What's the real advantage? It's that these tools give you a kind of superpower. They're the lens that lets you see right through that green surface to the red core underneath. They let you find your true confidence level for a deadline. They help you focus your team on the stuff that actually matters, and they let you choose your path based on cold, hard data, not just a gut feeling.
And that really brings me to my final, and I think most important point. Look, your value as a project leader isn't just knowing how to run the software or calculate a formula. It's about being the integrator. You have to be the one who sees the connective tissue, the link between all this uncertainty and the actual value you're trying to deliver. So don't just learn the tools, understand the logic, and become that integrator.